Hey traders, Jamie Setley here with your March 17th Daily FX Technical Focus. A big day, up day in equities after the big down day on Thursday, as often happens. Near-term sentiment extremes characterized by news events and proclamations of the end of the world give way to a 200-point Dow rally. We got that today in Russia, although the markets did taper off a little bit towards the end of the day. Anyway, I'm going to take a look at dollar yen as the typical risk on risk off pair. Let's take a look. All right, so this is a weekly. I should also note that the interest rates were up pretty big today as bonds sold off. Dollar yen's only up about 0.3%. So I don't know, maybe a harbinger of things to come on the downside. But what's interesting to me, again, bigger picture observations. The break higher 2 weeks ago above the tight range that had formed throughout February was very quickly retraced. Okay, the high came, as these things often do, on a news event NFP, and the high itself happened to be the same level as the May 2013 high. It's also a 61.8 level if you draw that fib from here to here, the high to low of the year's range. And we retraced the whole thing last week. So the possibility of a break, I think, should be respected at this point, given the response or the reaction to the market at resistance, suggesting that it's not going higher. So if it's not going higher, it's either going sideways or lower. Now the market might want to fool around for a little bit within this, possibly 101 to say 102.30, 102.80 even range. But at this point, you do have a three-wave advance from the low. Okay, and Elliott, that's a corrective move, suggests to us that the larger trend is indeed lower. It's quite possible, of course, that the market does enter into a wider period of ranging, swinging sideways, goes into a complex sort of correction, but the burden of proof for that would be on the market to prove that that is happening. At this point, you got to work with what you've got, and we have a three-wave rally. Okay, so an impulsive decline, nonetheless, from the top here. So you could get a final poke here, I think, maybe a run on 100 spot 75, 101 area, and then possibly get some people chasing down here and get a rally corrective 102.30, 102.80, obviously with 102.50 being the middle there. That's kind of a sell zone for me. As far as timing is concerned, I don't really have that great of an idea of if this happens this week or the market continues to kind of meander sideways and we don't get it until later in March. But I've got 102.30 to 102.80 marked down as a big area to potentially sell into if the dollar yen does get back there over the next week or two. And going back to the weekly real quick, I want to highlight where the major support levels are for the dollar yen. You've got what I think are minor reaction levels at say 99 and 100 roughly, and not because they're round numbers, but they are former highs going back to 2013, April here and then October here. But the major level from a structural standpoint is probably closer to say the 96.50 to about 97 area. Why? Because that is the end of the pattern that launched the final leg up here into the end of 2013. So again, another Elliott principle here, that is the triangle, the end of the triangle here in form, not in price. The price low is way down here, but as far as the pattern is concerned, the end of it is right here. Okay, so you'd expect to have support there, at least a very strong reaction level, but I'm getting way ahead of myself here. Near term, you want to focus on short-term structure and what the market looks like if it gets up into 102.30 to 102.80, as that is resistance. Okay, so that's it for me today. Again, pretty slow going here in a lot of dollar pairs, just kind of meandering near dollar lows. See how the dollar yen reacts. If it gets up to the side of resistance level, we might have an opportunity. All right, take care.